With this, now I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced.